So where we left off the last session was that there are a number of ways to fund insurance policies in regards to dealing with the capital gains issue and the recapture tax issue when families, couples want to pass on their real estate assets to their kids and not force them to sell some of their best assets just to deal with the capital gain tax. So this particular strategy is a financing strategy, and for real estate investors who are very familiar and used to financing and dealing with banks as part of their investing pattern, this is a strategy and a structure that they would probably be very comfortable with. So the ideal candidate would typically be insureds that are probably 50 plus. It can absolutely work for any age. It's just when it comes to financing terms, the older the client is, typically the banks are friendlier because the way that these loans work is that they don't get repaid until somebody passes away. So the older that somebody is, at that point, that's when the bank is going to be repaid its principal. So insureds are typically individuals that are over 50 who are well established. They have good cash flow that generates consistent profits annually, and they're also active real estate investors, clearly. And a lot of their free cash flow, a lot of their investable assets are being deployed into real estate and into joint ventures with other real estate partners. And these are real estate assets, presumably, that have a projected growth on the market value. And as a result, there will be a capital gains tax exposure and some liability down the road. And the preference is that even though that these individuals see the value in having insurance in place to make sure that the insurance capital will cover the tax liability so that their heirs are not forced to come up with other assets or sell properties just to pay the tax. Their preference is to not tie up or divert existing capital or investments towards insurance premiums. Depending on somebody's age, those premiums can be pretty substantial.
So Eric, can I ask, so in terms of the definition of an active real estate investor, is there a portfolio criteria that we can give as a definition on this? Actually,
you know what, there really isn't. It could be as simple as somebody owning a family cottage as a recreational property that isn't being rented out, but that family cottage, because it's a secondary recreational property in Canada, primary residence is not exposed to capital gains tax based on the current rules. But any secondary properties, be it rental properties or recreational properties, maybe they have a condo in Florida, there's a lot of snowbirds in Canada. All these properties would be subject to capital gain tax on the market value that it would be assessed at above the cost base. So really, there's probably many Canadians that would qualify for this particular strategy. I think active real estate investors in particular are a good fit because they're used to the cash flow. They understand what's involved with financing and using debt and leverage to build their portfolio, right? It's the old OPM, other people's money. And effectively, this strategy works on the same principle. It's just that we're not leveraging a physical asset like real estate, an actual building. We're leveraging a life insurance policy asset, which is a little bit different. But the terms and the conditions and the principles are actually quite similar.
Okay. So now the interesting part that you brought up is that this is for people who are 50 years and older. So anybody
no, anybody younger, it works well also. Anybody younger, it works well also, as long as they have to understand that this immediate finance arrangement is designed typically for the debt to never be repaid. It's only going to be repaid at death.
Okay. Right.
Typically.
So if
now,
you're starting,
now clients can always sell an asset and use that asset to repay the loan, but it's generally designed to not be paid back during their lifetime. So if someone does this at age 30, they may have this deal in place,
right,
you know, upwards of 60, 70 years, decades really, right? So it's just the comfort level if clients have of having this as part of their overall debt portfolio.
Gotcha. Okay. No, I'm glad that we clarified that, because like, say for myself, I'm not 50 years old yet, but when I first heard about this concept of the IFA, I'm like, oh my gosh, this sounds fantastic. I should take advantage of it, right? So
yes.
when you first said for 50 and over, then I'm like, okay, well then that rules me out. So I'm glad that you clarified that part.
No. So, and the other thing is that you're a successful anomaly, right? It typically takes individuals to get into their 50s before they're established enough to be able to invest in real estate. So good on you. You're one of the few that have, that qualify for this earlier than that.
Okay. Well, then I think I need to take you to some of my networking events, because some of the networking events I go to, there's a ton of people who are under 50 who have accumulated way more wealth than I have already within real estate.
Well, that's fantastic. Yeah. That's fantastic. That's great.
Yeah. And if I may interject as well, guys, I'm glad you guys got an early start on the conversation. Thank you, Eric, for all your help. I definitely have seen the strategy be applied to younger investors as early as early 40s. And it really depends on the size of somebody's portfolio and also their goals, you know. And I find typically people who have children, they start thinking about these things even earlier, about legacy planning.
Perfect.
Okay. All right. And before I forget, I am not a financial advisor. I'm not a lawyer. And I'm not an accountant. So all of the information that I'm presenting is really just my ideas, my advice, my opinion. So before you implement any of it, get somebody else's opinion on this. Show them my video and see what they say. Okay. So just a little disclaimer there. So
we're going on to the next slide now.
Yeah.
The one that has a whole set of numbers.
There we go.
Perfect. Wonderful. Okay. So, you know, I think it's always easier to explain a strategy or a concept by looking at some real numbers. So in this case, we're dealing with an older couple, both in their early 70s, and they've been able to build up a real estate portfolio that's significant enough that the taxable liability has been determined to be about $1 million. And the concern is, you know, that they want to make sure that these properties which provide and kick out good rental income are going to be transferred over to their kids as a legacy. And the issue, of course, is that a $1 million tax bill could force the kids into either having to take on quite a bit of debt or maybe selling one of their prime properties just to pay off the tax man. So Eric, one of the things that they could do is buy insurance.
Eric, just ask a question. So when you say a tax liability of $1 million, you mean this is the capital gains from their entire portfolio that they would have to pay to the government?
Yes, this is the actual tax. This is the actual tax is $1 million.
Okay. And it could be a combination.
It could be $100,000. It could be, you know, $1 million is just a nice, easy number to work with, and it's quite linear. So if, you know, the tax was half, then the rates would be cut in half.
Gotcha.
So in this particular case, traditional insurance would be option A. And here we're just using a selection of different insurance companies. Different carriers are well priced at different age categories. So we're not here to represent any particular insurance company. We're just here to explain what a typical premium would look like. So if they went with an option A, where they would be funding the premium out of pocket, they'd have to divert about $27,000 a year annually. This is assuming that they'd be approved based on a standard health rating. And that's what they'd have to pay until age 100. We always like to do some calculations in terms of what that would look like from a investment return point of view. If, say, this is a joint policy, the way that these products are typically set up is on a joint last survivor basis. So when we have a couple that are married and they own real estate assets, what would typically happen is when the first one passes away, they're entitled to what's called a spousal rollover. So they would only be, so there wouldn't be tax due when the first would pass on, but when the second, either the husband or the wife, or same-sex couples, it doesn't matter. The numbers play out the same way. Once there is a rollover, then when the second passes, at that point is when the tax is going to be due. So the life insurance proceeds will pay out after both of them pass away. So assuming that the last to die or the last survivor lived to age 95, and today life expectancy in Canada is rising, and people are living into their late 80s and early 90s. So that's pretty realistic if someone is in good health. You see that the IRR at age 95, and IRR stands for internal rate of return, would be 7.5%. It would mean that they'd have to invest that $27,000 in a GIC on a pre-tax basis and earn 7.5% net $1 million. We know that interest rates today are quite low, so that's a pretty good deal. But it does divert assets away on a cumulative basis. If they live to 90, that's $488,000 that they'd have to divert into an insurance premium. So it's a way to prepay the tax, but on a less expensive basis, but there is a cost to it. Another way to do it is to prepay the premiums, which that's option B, which is $54,000 a year, and there they'd have to divert $544,000. The difference there being is that the policy's paid off after 10 years and no more premiums are due. And then option C is the type of policy that has growth in it and also liquidity. It's called a participating whole life policy, where it's not a stagnant $1 million. It's a policy that would actually grow in value over time. And frankly, this is the type of policy that would be utilized for the IFA strategy, which we're going to be talking about shortly. And this option C works well when the concern is that they've got a portfolio and the valuation of the assets, of the real estate assets, is going to continue to grow. Perhaps they bought in an area that's booming and the real estate is growing at a significant growth rate above inflation, and the concern is that the tax bill is going to be higher the longer that they live. Option A and B work well when perhaps a family is initiated what's called an estate freeze, when they can freeze the value of their assets. But if they have not, and they're looking at assets that are going to continue to grow, then option C would be the option. And you can see that the older that somebody lives, that the insurance proceeds are higher and grow beyond the $1 million. So those are the typical ways of funding. But in all three cases, there is a need to fund it and use their own capital to pay for the insurance. Option D is when we get into the immediate finance arrangement. And really what that is a financing arrangement which would be akin to almost buying real estate on a zero down basis. Because what's happening is that they're financing the premiums from day one, and they're effectively setting up a line of credit debt facility where they would have an annual draw that would be equivalent either to the cash value of the policy or even to the entire premium. And the more popular way of doing it is borrowing back the entire premium. And I'm going to walk us through the numbers and through the process, but effectively their net out of pocket, the layout for this strategy and structure does work out to be effectively zero. Now, when we're dealing with commercial banking, typically there are going to be some upfront costs, there's some legal costs, there's some setup fees, there's annual review fees. So there are some costs vis-a-vis the banking, and there's some servicing costs from an interest point of view, but the cash flow can be structured in such a way where still it would be net zero out of pocket. So using this strategy can allow this couple, irrespective of their life expectancy, whether it's, you know, age 90 or 95 or beyond that, to have the insurance proceeds that they would need to deal with the capital gains tax bill, but still have those same premiums that they would have otherwise had to lay out back into their portfolio and being utilized in the way that they would otherwise have utilized it. So effectively, it does allow them to have their cake and eat it too. Continue to invest in real estate, but at the same time have this insurance asset that's going to be beneficial for them. Now, in this particular example as well, I've made an assumption that that the assets are held in a corporation, that the real estate assets are held in a corporation, and that the insurance is held in a corporation. When that happens, there is something in a private corporation in Canada. It's a notional account called the capital dividend account, and the capital dividend account effectively is a mechanism that once life insurance proceeds are paid into a corporation, they are paid tax-free. That's one of the benefits of insurance. But once the proceeds are paid into the corporation, the shareholders of record, which would typically be the next generation, would then be able to access those insurance proceeds, mostly tax-free, out of the capital dividend account. There is an adjustment, but for the most part, the vast majority of that does come out tax-free. So what ends up happening, if you look at the age 95 numbers, not only did the insurance net out to $1.3 million, but we also have a credit to the capital dividend account of $2.5 million, which means that not only did they get the insurance, but there's surplus on the books of the corporation of roughly another $1.2 million, which the next generation can then utilize to withdraw assets tax-free out of the corporation. And the reason why that's important is because when people pass on, corporations live on. Unless a corporation is dissolved or wound down, these corporations continue on, and the shareholders of record is now the next generation. And having this tax credit on the books of their corporation can allow them to have some real tax benefits for their personal lifestyles moving forward. So I'm now going to the next slide.
Oh, okay. So Eric, so
yeah,
let me stay on that slide just for a couple of minutes here, because I would like you to dumb it down a little bit for me. Okay. So
sure.
So just for example, so if I'm looking at that example option D, and you're saying the insurance proceeds at age 95, right? So I'm looking at $1.34 million. Okay.
Yeah.
So that means that if I was to die at age 95 and I went with option D, the insurance would pay out $1.34 million.
So the actual insurance would be higher. However, net of the loan, because these premiums have been financed, the outcome would be $1.3 million, and that's based on certain assumptions vis-a-vis interest rates and dividend assumptions from the insurance company.
So the idea
but effectively, this is the net return. This is the net return. This is the net after the loan has been repaid back to the bank.
Okay, so then the idea with that 1.3 is then that would go to like my kid or my estate, and then that would pay for the capital gains on my properties. Okay.
It would go to the corporation first, right, Eric? Because it's a corporately owned policy.
Correct.
The benefit would be paid to the corporation. If there is a loan balance outstanding, which there would be in this case because we financed the premiums, that would be paid to the bank. So the net payout to the corporation is $1.3 million. I think her question is how come the capital dividend account balance is so much higher than the life insurance payout?
The net, right. And the reason for that is because the capital dividend account is notional credit based on the total death benefit. So
oh, wow. Okay.
irrespective of the fact that the premiums have been financed, from the point of view of the capital dividend account, it's based on the total amount of the insurance that would be credited, irrespective if there was financing involved.
So to simplify that even further, that would allow the heirs in this case to potentially pull out more money tax-free out of the corporation, correct?
Correct.
Okay.
Yes.
Okay. And so
okay. So if we go ahead.
So then that $324,000 that's listed there as the cash value at age 95, what does that represent?
That's surplus cash value, net of the loan, that if they wanted to access to borrow, that they could, because the way that these line of credit debt facilities work, and I was going to get into more detail on that in the next slide, is most of the lenders will lend anywhere between 90 up to 100% of the cash value. And so this assumes, in this particular example, that 100% of the cash value has been borrowed, but there's still some surplus cash value available if they wanted access to it.
Okay. So then
it doesn't form part of the death benefit, but it just gives them some additional room to borrow if need be.
Right. So then the way I'm seeing this then is that when I pass away at 95, when my son inherits my corporation and all the properties and everything, he takes that 1.3 million, pays off the capital gains. Then at the same time, he's almost like getting a HELOC with $324,000 available to him.
No,
not exactly.
No. So the actual $324,000 is only utilized during your lifetime. Once the insurance proceeds are paid off, then that's that. At that point, the deal ends. But what your son would have is a capital dividend account credit. So after he uses the $1.3 million to pay off the tax man, he'd still have about $1.2 million left over in capital dividend account credit that he can then utilize for access to other assets in your corporation. So if he were to say at some point sell off some real estate and he was liquid and he wanted that for personal lifestyle expenses or to access to invest personally, he could then withdraw those funds tax-free. Normally, to withdraw funds out of a corporation by way of a taxable dividend, if we're dealing with Ontario tax rates currently, it can be as high as 47.4%. So that's a significant value add that's part of this strategy.
Okay, gotcha. So really then that $324,000 would serve as a HELOC to me between the ages while I'm going on, and then I would have $324,000 from 95 till 100 to the point that I died.
It's just extra borrowing capacity. That's what it is.
Okay, because in my mind I'm thinking, okay, at 95 I can take that $320,000 and buy another property at age 90.
You actually theoretically could. You could. Yeah. Listen, hey, you know what? If you're sharp enough still at 95, then absolutely you could take the 324 to buy another property. Now, by doing that though, because you're borrowing more, it would mean that you net out a little bit less insurance as well, right? So, if you borrowed it at 95 and passed at 95, you would take your $1.3 million minus the 324, and you'd still net out $1 million. So So you would still be able to buy the other property, but you'd have about $324,000 less in insurance proceeds.
Okay.
I also want to say, guys, sorry, Eric, for interrupting. And Huong, you know what? The numbers actually look a lot better if we were to run this illustration for younger clients. So if we were to run the same numbers for a client that's in their 40s, the premiums would be a lot lower for the same amount of coverage. And also you'd see the value of the policy, you'd see it grow significantly more than from 1 million to, let's say, 1.3 million, even with the IFA strategy, simply because you just have more time for the cash values to grow, for the policy to grow. So it's always better to put this in place. The younger and healthier the client is, the more options you have in the marketplace, and you also have a chance for these policies to keep up with the growth in your portfolio as you keep growing
Okay.
in your real estate
So
investing.
can I ask that you guys send me this table for somebody in their 40s? So if they were to start out,
Absolutely.
okay, because
Yeah.
that represents me and most of my clients.
Yeah.
Right.
Yeah.
Okay.
So,
Fantastic.
okay, so that's great.
Sure.
So now my last question on this. So if I was to go with option D, and in this scenario, so if I was 73 years old and I was going with this package here, what would my premiums be?
So that's what I want to walk you through next.
Okay.
So if we go to the next slide,
okay,
that's really just a summary of the benefits that we've already talked about in terms of what is the outcome,
okay,
and what the cash and tax advantages are, right? So just a quick summary. The tax-free estate benefit through the life insurance to deal with the capital gains tax and the estate tax liabilities, the increase of the capital dividend account. There is another benefit that we didn't really touch on, but is also important when it comes to permanent insurance policies under Canadian rules. And that is the cash value portion that one would pay above the premium. And current rules allow extra funding anywhere between 8 to 10 times the premium. That cash value, which forms part of the policy and is invested in a couple of ways. One could be a self-directed account, which is called a universal life policy, where an insurance company would provide a menu of different options to invest in, ranging from mutual fund portfolios and market indexed accounts, GICs and bonds, to a participating whole life policy, which is more of an institutional asset pool that's being invested by the insurance companies, that would include investments like bonds, private fixed income, corporate bonds, government bonds, real estate investments that would include part of the rental income, commercial mortgages, and that asset pool is managed in such a way where the returns are smooth. There's also an equity component. So by smoothing the returns, it provides for a very, very stable return. And the returns historically have been a little bit higher than they are now because we're in a low interest rate environment. But we're looking at effectively in the neighborhood of 5 to 6% currently from an actual return. And because that's a tax-free return, that's actually a very significant yield for a low-risk investment. There's also a mortality component where part of the profits that the insurance company benefits from as part of the pricing on the product is passed on as part of the investment return. So the benefit there effectively is, unlike a traditional investment portfolio, be it rental income above the depreciation, or if it was a GIC or a stock portfolio, those same investments outside of an insurance policy would be subject to tax. So the financial institution would issue them a T5 or a T3, and they'd have to pay tax. So simple math, if someone's at a 50% tax rate and they bought a GIC with a 3% return and the GIC was worth $100,000, at the end of the year, that GIC earned them $3,000, but they'd be issued a T5 where half of that would be subject to tax, so they'd really only net 1.5%. That same GIC, under the umbrella of the insurance contract, would retain its full value because it's tax exempt. So that's just sort of another benefit, that the assets in these policies do grow on a tax-free basis.
Okay.
And then, of course, the fourth point is the cash flow, which we were speaking about earlier, that there's no net out-of-pocket layout for the insurance.
So I did have a question though. If somebody wanted to sort of get an idea of the bank setup fees and the annual fees and so forth like that, on average, are we saying it's maybe $1,000 a year that they can expect on this, or is it more like up to the $10,000 range here?
No, it won't be.
Right. So the initial setup fees, there would be legal fees, and depending if the client uses their own lawyer, or if they use a lawyer that's recommended by the bank, they might be looking at around $2,500 to $3,000 for the legal fees. And then the setup fee would be dependent on the size of the facility, and it'll range from, you know, maybe as low as $1,000 up to $10,000 if we're looking at a facility that's in the millions. Beyond that, there would be an annual review fee, and again, that would be negotiated with the bank. And you know, I've seen them as low as $300-400 a year to maybe $1,500 a year. So it's typically the larger the size of the facility, the larger the fees. So basically, the larger the deal, everything is relative.
Okay, so you said that if it was $1 million package, like so $1 million coverage, you were looking at about $10K a year.
No,
No,
Huong, no, sorry.
So remember that they aren't borrowing against the death benefit. They're borrowing against the cash value. So even if it was $1 million facility, we might be looking at anywhere between 10 to 25 basis points on the overall facility. And that isn't necessarily for the entire size of the facility during their lifetime. It's one that would be initially set up. So the $10,000 on $1 million would be very high. It would be very high.
No. So he's talking about, Huong, he's talking about the size of the premium loan. We're not talking about the size of the actual life insurance payout. Again, the IFA is a strategy that allows the investor to, as soon as they pay the premium, borrow back the funds and be able to then use the funds to reinvest, let's say, in real estate. So the bank, the lender in this case, is advancing them the funds so that they can borrow back their premium right away. You know, it's a premium loan. And so that loan is based, and Eric will go, I assume, in the next few slides. It's based on the size of the cash value inside the policy, and then in the initial years they may also require some additional collateral to be able. It's a secured line of credit against the cash value of the policy, and they may require some additional collateral to provide this loan, the lender in this case.
Okay.
So typically, how a permanent insurance policy works that has cash value in it, the client or their corporation, depending on how it's owned, would deposit their annual premium, and that premium would then be invested in this tax sheltered account that I was speaking about. And then depending on whether it's a universal life or a whole life, it would be either invested in some index accounts or GICs, or in a participating whole life, which uses that institutional smoothing approach. So that's the traditional way of doing it. If you go to the next slide, the immediate finance arrangement still uses that same first step, where they still have to deposit the funds into the policy first. But then what would happen is they would set up this line of credit facility that would allow them to borrow back those premiums immediately. The reason why it's called an immediate finance arrangement is once the facility is set up, once the lender has the policy assigned and they've got all the cash value statements and everything is in order, it typically takes about 5 business days for them to then deposit that loan draw into the client's account. And this would be something that would be done on an annual basis. So the goal here would be to fund the policy first, borrow back those same funds, and reinvest them in a financial vehicle outside the policy according to the personal preference of the investor. So if we're dealing with real estate investors, then typically they're going to take back those proceeds and redeploy them as they otherwise would into their real estate investments. Okay, now the next slide is another visual, which is walks you through the entire process from beginning to end. So if you start on the left side, you can see that the life insurance policy is set up. So I've now moved slides. If you can move the next slide, please.
This one?
So the life insurance policy is set up. It's assigned to the bank. The bank will then lend as much as the entire premium back to the client. Those funds are then invested in a business or real estate investments. And this is a cycle that goes on an annual basis. Behind the scenes, of course, interest is being serviced, interest is being deducted, the net cost of insurance is being deducted, interest can be capitalized, and we're going to get into those details on the next slide. But effectively what happens is we have a policy that's being funded that continues to grow, and we also have a loan balance that's also accruing as well. At some point, the life insurance proceeds are going to pay out because the clients have passed away. The death benefit is then used to repay the bank, and then the net proceeds are paid out to the beneficiaries. That's effectively how the strategy works. If we now go to the next slide, we're going to see a lot of numbers, and this is the structure of what it would typically look like. So in this particular case, the policy type that we would be using, and the one that makes the most sense, is the one that allows a client to deposit the maximum allowable under the income tax rules currently, as they are set up in Canada, the maximum amount into these policies. So in this particular case, for our clients that are in their early 70s, for $1 million policy, they can deposit as much as $98,000 a year into this policy. So 98,045, and because it's a liquid type of policy, it does create cash value of $56,000 in that first year. So if we look at the columns starting from the left, so year one, the end of year one, the clients have now turned age 73. The premium is $98,000. The cash value that's generated in that first year is $56,000, and the total insurance has grown from $1 million to $1,103,000 with that initial deposit. Now the loan rate that's being used here is prime plus a half, and here the facilities are interest-only facilities. Most of the major banks in Canada are in this space. There's a couple of specialty lenders that do specialize in lending against cash value of a insurance policy, and the rates vary. I've seen as high as prime plus 1.25 to as low as bankers acceptance plus 100 basis points, which is actually below prime, and it's typically a floating rate linked to prime. So just for the purposes of this example, we're using a prime plus a half. This rate would be negotiable with the bank, and it would really depend on the credit worthiness of the client, their assets, their income, and the relationship that they would have with the bank. So when we do this with clients, and we usually do about 3 or 4 of these a month, we will shop the rates for them. We'll always approach their existing banking relationship first. And then we'll also look at some of the other banking facilities that are in this space to make sure that the client is getting the best possible deal from an interest servicing point of view. So then what would happen is you see the next column over is an annual loan advance. So in this particular example, the client is going to borrow back the entire premium. So they've deployed 98,045 into the policy. They're now going to take back an annual loan of 98,045, and that is going back into their portfolio, and that's going to be reinvested as they otherwise would. What we're not showing here is the return that they're generating from that outside investment, because that, of course, would be on a case-by-case basis what the client earns. So that's sort of a separate category, but But what's happening is that that 98,000 is now being invested, and it is an asset that they've got access to. Because this is designed to not repay the loan principal, you see that the loan payment column there shows 0, because the goal there is to repay that with the life insurance proceeds. Because we're able to deduct
when the client
interest,
eventually passes away, Huong. Just wanted to clarify that. So
correct.
Okay.
Now, unless of course clients have a windfall of cash and they just want to repay the loan, they're always entitled to it. It's an open-end and loaded, but it's typically set up to be paid by the death benefit proceeds. So you see a tax savings column and a outstanding loan balance. The tax savings column, I'm going to, there's a cash flow slide which I'm going to talk about next, but effectively what happens here is when you borrow to invest, as long as there's a reasonable expectation of earning income according to Canadian rules, that the interest is tax deductible. Another benefit of assigning a life insurance policy is collateral when it's required by a financial institution like a bank, is that a portion of the policy on a pro rata basis is the net cost of pure insurance would also be deductible. So even though the client is funding interest out of pocket, because they're able to deduct that interest, they do get that back in the way of a tax credit or a tax refund on their balance sheet. So their net out of pocket is actually going to be reduced. And then, of course, part of this structure on the 0 out of pocket basis would be that when they then are servicing the interest on a monthly basis. So let's use simple math here. Let's assume it was a $100,000 policy premium, and their loan interest was 5%, and their first year interest payment over the 12 months was $5,000. So it would effectively mean that they actually serviced $5,000 of interest during that 12-month period. However, because they got to deduct the interest and also deduct the net cost of pure insurance on a pro rata basis, it really only cost them about $2,500 net out of pocket for the year. When they would then take their next loan draw, their next $100,000, they would also borrow back the $2,500, the imputed interest that they would have paid out of pocket. So on a 12-month cash flow cycle, they actually recovered even the interest that they paid into the program. So that's when we say it's a net cash flow. It's net cash flow 0 when everything is factored in. So going back to the columns, we see that the outstanding loan balance is $100,114, and that's because we've assumed that they've capitalized that portion of the interest. And then you can see the additional collateral column, and that's what was referenced earlier.
So, Eric, just to interrupt for a second.
Yeah.
Sorry, because I don't know if people know what capitalizing the interest means. So, as a client, when you take this IFA loan, you have the option of servicing the interest or paying the interest, and then because you're using the proceeds of the loan for reinvesting in real estate, in this case, you can deduct the interest. The interest become deductible in addition to a portion of the insurance premium, which you call the net cost of your insurance. You also have the option of not even paying the interest. That's what capitalization means. You can literally add the interest to the loan balance, and eventually at the end of the day, the loan balance plus the accumulation of interest would eventually get paid out of the life insurance proceeds. So the lender will get their money one way or another. So you can choose to service the interest, or you can choose to let it accumulate. Eric, doesn't it make more sense to service the interest since it's deductible anyway? Do you find most clients?
Yes, right. The vast majority of these deals are set up with servicing interest, and frankly, true interest capitalization is not generally available on an IFA arrangement, on an immediate finance arrangement. They are available when we have clients above age 50 that have maybe funded a policy for 5 years before they start borrowing. At that point, then the banks would be more open to allow pure capitalization, meaning that they're not servicing the interest at all. But for the purposes of our conversation today, when it's an immediate finance arrangement, almost always they will be servicing the interest, but they have the option to capitalize that interest, but they're still having to physically pay the interest on a monthly basis, but then can capitalize all of it or a portion of it at year end. So going to the additional collateral column, effectively what that means is because the cash value in the first year was $56,000 and the premium was $98,000, there is a shortfall there. So what the bank would require initially would be the posting of ancillary collateral above and beyond the cash value of the policy. Because remember that the client here is not borrowing against the death benefit per se, they're borrowing against the cash value. So the ancillary collateral, and we'll get into more detail on another slide. You know, it's a pretty flexible option for the client. It can range from a letter of credit, could be residential real estate, it could be GICs, marketable securities. And what additional collateral really means is that the client still has access, still could invest that asset that's being posted as they otherwise would. They just couldn't liquidate it during the time that is being posted. And you can see that the additional collateral column in that first year is $43,000. It then goes up to $73,000 the next year. It doesn't mean it's the $43,000 plus another $73,000. That's a cumulative amount. So it would just mean that they would have to post $30,000 the following year. What most banks will do is they'll look at the peak collateral year, and this year it would be year 4, $97,000. They'll ask the client to post that initially, and then as the cash value in the policy grows and the loan is growing at the same time, however, the cash value eventually is going to exceed the need to post additional collateral, and you can see that additional collateral column is down to 0 eventually. The other option is clients can simply not capitalize the interest, or they don't have to borrow the entire premium. They can only borrow against the cash value. And we've had clients that have paid the first year out of pocket completely and then start borrowing the second year. And by borrowing the second year, it would mean that they would not have to post any collateral at all because there would be sufficient cash value. And then you can see the net death benefit column, which would mean that after the loan has been paid off, that's the net death benefit proceeds. And then the CDA credit column is the column that is referencing that capital dividend account credit that we had spoken about earlier. And then the last column is the loan to CSV percentage. That would be the ratio that would be reflected in terms of how much of the borrowing is compared to the cash value. So whenever it's above 100%, it means that they need to post additional collateral. And once it's below 100% and down to 90%, then they don't have to post any collateral at all. That's similar to, I guess, a loan to value ratio on real estate when you're taking out a mortgage, right? You know, the value of the property could be $1 million, and if the maximum loan to value is 80%, then the most that the bank will lend against that real estate asset would be $800,000. The difference here with insurance is that the loan to value ratios are higher. They're 90 to 100%, and any excess would have to be using additional collateral. So if we flip over to the next slide.
Sorry, 1 second. Yeah. Eric, I don't think you hear me. Okay, sorry. So I just want to make sure, because you're going pretty fast, and I want to make sure that people understand how the whole thing works. So the lender in this case that will advance you back the premium money. So you pay, in this case, the clients are paying $98,000. The lender uses the accumulated cash value inside the policy as collateral. But as you can see, Huong, in the initial years of the policy, there is a shortage. The cash value is not as high as what the client has paid in premiums. And because this is a secured line of credit, essentially, they need that additional collateral from the clients. That's where this additional collateral column comes in. And Eric will then explain, in terms of what type of additional collateral lenders would accept for this type of loan. And what Eric was also explaining is that the client doesn't have to. So let's say if the clients have the liquidity to pay the premium and maybe they don't want to borrow back the entire amount, they could very easily just borrow back or borrow back only up to, let's say, 56,000 or 120, like whatever the cash value is, and not have to post additional collateral.
Right.
However, if we're dealing with investors that are in their growing stage of the business, they don't really want to tie up, you know, even 40,000 in premiums. Perhaps they want to be able to access back that money right away and reinvest, let's say, in real estate. That's where that need for additional collateral arises, because they want to borrow back the entire amount, not just up to what is in the cash value of the policy. Make sense?
Okay. Now, the banking terms are typically where the minimum size deal that's available currently is probably around $30,000. So, you know, it couldn't be for very, very small policies. You know, for it to be worthwhile for the banks to get involved in this type of a arrangement, we're typically looking at minimum premium size of $30,000, and most of the bankers that are in this space are looking at premiums in excess of $100,000. Just one last point before I wanted to get on to the next slide. We were looking at the first year values, but if we say looked at the age, and if we went down to age 95, which was referenced in our earlier discussion, by 95 you can see that the cash value for the policy has grown to $3.2 million. The total death benefit is over $4 million. But the outstanding loan balance has grown to $2.6 million, and that's where that net death benefit number came to be. It was the total death benefit minus the loan balance left us with a net death benefit, if you look at that column there, of the $1,340,000, and then you see that excess CDA credit, the $2.5 million. So you can see on a year by year basis how these numbers play out. And one of the things that we'll also do is send you some slides and numbers that reflect a younger client. And with a younger client, the ratio of premium versus the size of the policy, because they're younger, the premiums are going to be less expensive for the same size policy. As well, we're also dealing with more years, right? You know, and the power of compounding allows the policy to grow at a more significant value.
Yeah.
Okay, so let's go to the next slide.
Sorry,
Huong has one more question.
A question about the collateral, the additional collateral requirement. So as long as we don't sell that property, then we can use it. And so then how does it show up on title? Or is it just a lien, or is it just a separate legal document that doesn't show up on the searches, so that as an investor, I can still use that property and leverage it?
Correct. So depending on the lender and depending on the individual, sometimes they would be willing to take second deposition as a lien if there's already a mortgage there, or sometimes they will want first deposition. So we have clients that use residential real estate rather than their investable real estate assets, or they can secure a letter of credit from their bank, and then the bank would use that as opposed to a direct lien against the real estate. Now, there are other options, which I'm going to walk you through a couple of slides from now, vis-a-vis the ancillary collateral. If we go to the cash flow page, I just want to drill down on what I was speaking about earlier about the servicing of the interest, and also, no, if you go to the next slide, correct, about how the cash flow would actually work. So going back to year one, you can see that there's some deductions available. So one of the deductions, that column that says the lesser of premiums or NCPI, that's that net cost of pure insurance deduction. The older the clients get, that deduction actually gets larger. If you go to the column about middle of the page, just next to loan rate, just to the right of where it says loan rate, there's the annual loan interest. That's the actual loan interest that would have been serviced on an out-of-pocket basis for the year. Then the next column is the tax savings from the interest. That's the amount of tax credit, tax refund that they would have gotten back into their portfolio. And then you can see in red the net interest that was capitalized. That's the amount that they borrowed at year end to add to the loan to recover the interest, the net interest that was paid. So the long and the short of it is that their net out of pocket for that year was zero. And of course, in order to be able to deduct interest, they have to have sufficient income to be able to use those deductions. So you can see, if the clients lived, well into their 90s and past 100, they would need to show sufficient income in excess of 100,000 or 150,000 to make sure that they can benefit from those deductions as well to get that tax refund and that tax credit back. Any questions before the next slide? Okay, let's go to the next slide.
So Eric, just to clarify, sorry, could you go back one? Okay. So when it says annual loan interest, so that is, let's say in year 6, the client would still have to come up with, in this case, 22,000 or whatever it is.
Yeah.
Sorry, go back. Yeah. And then
it would come up with 22. They'd get back 11.
Got it. Got it.
And then the balance of that, around 10,000, would be added onto the loan. So they would recover that back. Correct.
Oh, okay.
Okay, so now let's go to the acceptable ancillary collateral, and this varies by bank on a case-by-case basis, but you can see that letter of credit is probably the easiest, although some banks would charge some basis points to be able to do that, but a letter of credit is one way of posting additional collateral, especially if there's real estate assets that they can post. A GIC would be a simple asset that can be posted, and the margin for GICs is typically about 100%. If they've got other insurance policies, we have a number of clients that already own insurance. If those policies have some cash value, they can get anywhere between 50 to 100% margin on those additional insurance policies that they've just been funding out of pocket. So we have clients that use those policies as the additional collateral, or marketable securities or managed debt portfolios, depending if it's an equity portfolio or if it's a balanced debt portfolio, then they'd get margin as much as 50 to 80%. And then residential real estate in a priority position or in a secondary position, depending on the lender, depending on the real estate, it can be anywhere between 65 to 80%. So again, these are more banking terms and how the financing component works. And part of what we do for our clients is that we work with them and also with the lender to get the best possible terms for them. And remember that posting collateral doesn't mean that they don't have the use of that asset. It just means that they can't liquidate it during the time that they're posting the additional collateral up until the time that the cash value grows. And then if we go to the next slide.
Sorry, yep. Eric, may I interrupt? Would you be able to define for us what a letter of credit is? I've heard that buzzword a lot of times, and if I were to explain it to a client, would you have an explanation for what that is?
Well, a letter of credit basically is a document that they would get from usually their own bank, that their bank would securitize their assets. So if they're borrowing from another bank, the guarantee, the collateral that's being posted is being really secured by the bank. So for example, if someone's got a real estate portfolio with $1 million in equity, they might take a letter of credit against that real estate portfolio. So let's say that they bank with TD Bank. TD Bank would then provide them with a letter of credit. And if Scotiabank is the lender, Scotia would use TD's letter of credit as the ancillary collateral.
Okay.
Okay, let's go to the next slide.
Thank you for clarifying that.
That's the financing matrix if they were looking at a 10-year line of credit. So there's some banks that will not re-underwrite the loan for as much as 10 years. Some banks will re-underwrite it annually. Some banks will do it every 2 years, some every 5. So the range is different from bank to bank, and the terms are different from bank to bank. But keep in mind, these are typically set up not as a equity loan, where they're just borrowing against the cash value of the policy and that they don't have to show financials or any of that. There's full commercial underwriting. So they would typically want 3 years corporate financials, 2 years NOAs and T1s. They would look at their total debt service ratio. So it's up to the lender's discretion. Some lenders have terms that are a little bit more streamlined, and they don't ask for as much, but usually the larger the loan, the more that the lender is going to ask, and the more that they're going to need vis-a-vis minimum income, be it personal or corporate, and also what their investment debt portfolio is. So part of the process
are the
is
lenders normally when the A lender banks that we're used to, like TD and CIBC and stuff, or are we talking?
Yeah, so all the Schedule 1 banks are in this space in Canada, typically through their private banking arm. There's also a specialty bank as well, Manulife Bank, which is a big player in this space. There's Equitable Bank now is in this space as well, and their lending terms are a little bit more streamlined. So there are a number of different options for clients to go to. There's a couple of credit unions, and again, the terms and the conditions will vary from bank to bank. But part of the process that's involved is we will typically, because there's 2 underwriting that is going on when these things are set up. The first underwriting is the medical underwriting that the clients have to qualify for, to qualify for the insurance, and that can sometimes take, 4 to 6 weeks.
Well,
and during that time, we'll also get the financial underwriting set up. So we try to align as close as possible the having the loan approved at the same time or even prior to the insurance being approved. So that way that there is no time gap from the time that they want to set this policy up to the time that they're going to be taking their loan draw. The next slide is more about financial underwriting considerations, and that's where this is not qualifying for the loan, this is qualifying for the insurance. And insurance companies have their own guidelines on how much insurance somebody can qualify for. If someone is earning $50,000 a year on paper, they wouldn't qualify for a $20 million policy, right? They have certain considerations, and what they'll look at are factors of income, where they might qualify based on their age up to 20 or even 30 times their income. They would look at their net worth, usually 50% to 100% of their total net worth. So there is a certain capacity of insurance that an individual can purchase as well. So part of what goes on behind the scenes and what we help clients with to guide them through is, first we have to establish what is the insurance need. Do they have the assets and the income to qualify for that amount of insurance? And then of course we qualify them for the loan as well. Generally speaking, insurance financial underwriting, the guidelines are very, very generous, and we never have an issue with clients qualifying for the amount of insurance that they would need. If we go to the next slide, this just talks about the flexibility and the exit strategies and what are the potential risks. So these loans are usually set up as demand loan facilities. They're not on a non-recourse basis. However, it's very, very rare where a bank will actually call one of these loans. The only, I think I can count on one hand the amount of loans in Canada in history that have been called, and it's usually because of bankruptcy or insolvency or those types of issues. But typically, as long as the client is meeting their TDSR and as long as nothing significant happens, the banks will typically not call the loan. However, if circumstances change and the structure is no longer viable. Clients always say, well, this is a great deal, but what if I can no longer fund the premium, or what if things change in my life that this deal no longer makes sense? What are my ways to get out of this? So one of the ways to get out, clearly, they can always cancel the insurance and use the cash surrender value to repay the loan. If that's done early on in the first decade or so of the policy, there wouldn't be a disposition to cash in the policy, meaning that they wouldn't have to pay tax to cash in the policy to repay the line of credit. The downside of doing that is that they would then lose the insurance, and they may not be able to requalify for it in the future. It might be more expensive. They may not be healthy enough. So another option is to maybe reduce the coverage, pay a lower premium, and maybe continue to borrow, but at a reduced amount, or maybe to stop borrowing, or maybe even do what's called a reduced paid up policy, where after a few years of paying premiums, and let's say that the policy was worth $1 million when they first started, but now they're eight years into the policy, the goal was to fund it for 20 years or for life, they can go back to the insurance company and have them make a calculation where they would reduce the insurance maybe from $1 million down to $500,000 or to $600,000, but it would now be fully paid up. No more premiums would be required. The cash value would still be intact. It would still continue to grow, but on a reduced basis, and they can then still extend that line of credit, that facility, on an interest-only basis, but not take any more annual draws. So effectively, it would just make the deal a smaller deal than they originally started. Another option, which isn't very well known, once we have surplus cash, where there is more cash value available to them, where they don't need to post additional collateral, and that loan to value ratio is, say, less than the 90%, at that point, because there is some surplus cash, if the client needs to, they can always withdraw excess funds from the policy to perhaps service the interest as well. That would be taxable if it's later into the policy, but if they're not able to service the interest once those interest payments get significant, even if they've got the ability to write it off and to borrow it back, but if it's just not viable or feasible, another option would be for them to use a withdrawal from the policy. So again, the reason why we like these arrangements is, yes, they can be complex, but they're flexible. And if clients need to wind down the structure, they're absolutely able to wind down the structure. So that's basically the overview. I know it's sort of the Coles Notes version of it, but we wanted to give you a sort of a sample and a flavor of how these arrangements work. They work very, very well for the right client. And if it's a client whose profile, again, is one that's an active real estate investor, they're comfortable with leverage, it just becomes really another deal for them, where just like they're financing the purchase of real estate assets, they can also finance their purchase of insurance and help keep these assets in the family and deal with the capital gains tax issues that would otherwise have to be dealt with in a different way by the estate.
Right. It's another way for them to access other people's money, basically. And
nice.
Absolutely. Yeah. It's an OPM deal. Absolutely. Yeah.
I like how you put that.
And with investors, we get tapped out after so many properties or so many doors, right? And so this is another way to leverage that and to get additional money some other way.
Correct.
Potentially.
Correct.
I mean, you still have to qualify for the loan, and there's no guarantees, but I mean, it does work for the right profile of client. And I've seen this work, Huong, like I said, for clients in their early 40s who had like a multi-million-dollar real estate portfolio. Client had young children. He was concerned that he understood the tax consequences of owning investment real estate. And at the same time, he didn't want to tie up his capital on an annual basis paying for these premiums. So this made a lot of sense to him. And again, this is typically used for for investors and entrepreneurs that are in high growth industries, we know real estate investors, if they know what they're doing, which they will, if they're professional investors, they could get returns of upwards of 20% per year. So it's understandable that they'd rather use the money to do that. But if you can have your cake and eat it too, you get the best of both worlds. You get to continue your investing, and at the same time, you get to protect your assets on the back end in the most cost-effective way possible.
Mm-hmm. So now let me ask a question. So there was a discussion of bringing in a lawyer, right? So can any lawyer be involved, or is there a specific lawyer that would have to be brought in to do these types of arrangements?
Well, it's similar if it's a lawyer that's familiar with registering a property when they're taking out a loan or setting up a line of credit or a mortgage. Then the documentation is similar. There are some lawyers that do specialize in these types of arrangements. So if a client's lawyer is not familiar with it, then we would refer them to some of the lawyers that we deal with that are familiar with these products and structures and strategies.
Okay. Yeah, no, I was really glad to see that there's an alternative once, like if somebody gets to the point where they're like, oh, this policy is too much now, you know, so I'm glad that this slide was in here to show that there's an alternative. Okay, so I guess the big question that I have, okay, so like when I look at some of the numbers here, if somebody's paying a premium of $100,000 a year, right, into this policy, and then on top of that, so they're paying in $100,000, and then they're also putting a collateral on one of the properties that they have of $40,000 in the first year, okay? The first thing that comes to my mind is, hey, if I have $100,000, I can take that and put that into a JV at 20% equity and buy a multiplex with somebody.
So you can still do that. That's the nice thing. You can literally within days of, that's the whole point of the IFA immediate financing arrangement, Huong. That's exactly it. That you'll pay the premium, and within a few days you have the money right back to do whatever you want with it, to do exactly what you just said. Okay. And so that's exactly the purpose of the strategy. It allows. So
really, that's really the ideal client profile. It's not for someone that's borrowing it back, doesn't know where to put the money. It's for someone that already has investments that they're comfortable with, that they're generating a good return on, and frankly, on the arbitrage between, even if they were paying the interest, if they're earning more on these other investments than it's costing them in net interest, and we're in a low interest rate environment, then it's absolutely a win for the client. And the more sophisticated the client is and understands the use of other people's money, they feel very, very comfortable with this.
Okay.
Huong, you're basically getting two assets. Yeah, Huong, you're getting two assets for the price of one. You're like I said, you get to accomplish both your purposes. You get to protect your estate by acquiring this policy, but at the same time you have access to your money right back, and you get to continue investing in real estate. And because the life insurance benefit, also known as the death benefit of the policy, will always grow larger than the cash value and the size of the loan, even though you're continuing to carry this premium loan, it will eventually be paid down out of the value of the life insurance payout. Not unlike how when an investment property may still have a mortgage on it by the time somebody passed away. You know, you may still have a mortgage on your property, but the property value is much larger than what the mortgage amount is. That's kind of the idea here. There's always going to be a net. In this case, the policy provides liquidity to the estate so that you're now not having to liquidate, that your heirs don't have to liquidate real estate assets to pay the tax man. The policy now provides liquidity that will then be used to take care of the taxes, and that way you get to keep more of your real estate wealth in the family, truly creating that multi-generational wealth that we like to talk about in real estate circles.
Okay, perfect. So
and also because this is an open-ended line of credit, if the client is very liquid and let's say sold off some of their real estate assets, they could always just use those funds to pay off the loan, and then they'll just be left with a much larger policy. And basically in the future, they can start that facility again. So it's very, very flexible.
Okay. Okay, so I brought this slide up because I just wanted to clarify something here. So the very last line, it says residential real estate in priority position, and then 60% margin. So if I had a property and then we were doing this type of insurance package, and I had an insurance, a property. So does that mean I can have a first position mortgage with, let's say, CIBC, and then use that as collateral with the lender, whoever it is for the insurance policy, and then together, whatever debt ratio coming out of that would only go up to 65%?
Again, that's just, you know, it really varies based on banks. That's roughly an average, you know, in terms of some of the arrangements that we've done. There are some that will allow you to take a second position. In other words, almost like a line of credit sitting on top of the regular mortgage. And that's actually a common structure. A lot of people have their residential mortgage, and because the market value of their home is so high, they also have a line of credit sitting on top of that. So it would effectively be the same thing, where they would just use that line of credit as the additional collateral component on a temporary basis.
Okay. So that is why this type of insurance policy actually makes sense for the older crowd, because it's the older investors that would have paid off a lot of the mortgage.
They typically have a lot of equity. You got it.
Exactly.
You got it.
Exactly. Whereas
if someone has a starter home and you know, with very little equity, then they need to use other assets.
There
Absolutely.
has to be some equity in the properties, Huong. However, you know, the lenders, and some of the lenders are more flexible as to what amount of equity and depending on the size of the portfolio, I think it always merits at least looking at this strategy, seeing if it's an option for younger clients. You know, I don't know if Eric went over that, but I mean, there's always the option of purchasing a large term insurance policy, knowing that you're going to have this huge tax liability moving forward. But what you have going for you now is you're young, you're healthy, you have a growing real estate portfolio. You know that sooner or later you're going to have this issue. So there are ways of getting into a policy on a very inexpensive basis if this option is not viable. Like, we can always look at the case, at the client's portfolio, and talk to our lenders, talk to your lender, your banker, and see if that this is a viable option. If the IFA strategy is not a viable option and the client is not comfortable putting too much money into a permanent life insurance premium, the backup option is that you could start off with an inexpensive term policy, which later can be converted to something like this, to a permanent policy, and potentially applying this IFA strategy. So
either that or just borrow against the cash value only and not post additional collateral. And in the first few years, they would be out of pocket for the difference. It's still an exceptional value because the out of pocket relative to the overall premium is going to be quite low. So either way, and again, on a case-by-case basis, we walk through all their options with the clients to explain to them what their various options are, and then depending on their comfort level, what they can qualify with, and what assets that they have to post, we end up making a final decision.
Okay, that's great. That should actually answer a lot of the questions that we get from people who are going to watch this video, right? So
okay.
That's great. So I found out about the IFA strategy a couple of months ago, okay? And I've been investing in real estate for 20 years, okay? And so for me to find out about this, you know, a month ago, it was like, wow, like how come this wasn't more out there, right? Like how come more real estate investors aren't aware of this, right? So why do you think that is? Like, why do you think that this strategy, this insurance strategy is not presented in a way where it says, hey, ding, 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 if you're a real estate investor and you have accumulated this much, or if you're planning to get to this much, then you should be aware of the strategy?
Well, part of it, frankly, has to do with it not necessarily being a mainstream strategy. It is becoming more and more well known, but a lot of it has to do with you know, the knowledge level of the advisor and them being comfortable with it. And I think real estate investors is a niche market that
one that I'm
is one where I
in.
think is one that that she specializes in, and that a lot of advisors just simply aren't in that space. As you know, the Pareto principle in life for all sales organizations in general is that it's the 80-20 rule. So in our industry, it's probably a 95-5 rule. It means that most advisors work in the family market, where they do a lot of very, very good work helping clients protect themselves against premature death and disability and critical illness, and that's their primary focus. But this is a more complex, high-level type of a product and a strategy, and there's probably only a handful of advisors in various towns and cities across the country that are capable of really managing it and doing it in a proper way.
Yeah, gotcha.
And Huong, you know, it is my intention to continue educating investors. I've been doing a number of appearances, even locally, and I'm going to continue doing presentations and creating content for investors. And I definitely think more investors deserve to know about this, because I think it's been my experience that a lot of investors don't even realize really the consequences of owning investment real estate, the tax consequences that are waiting for you on the back end. You know, I remember hearing an already successful multi-unit investor whose mentor owned about 200 units, multi-unit residential, and he asked his mentor, you know, what if you were my age? His mentor was now in his 60s or older, and the younger investor was maybe in his late 30s. And he asked him, you know, if you were my age, what is one thing you would do that would help you, you know, put you in a better position now? And he said, I would buy a $20 million life insurance policy, because the gentleman was now facing a $40 million tax bill on his estate. So you want to, you know, it's unfortunate that too many people don't find out about this option until they're already at an age where they may not even be able to qualify for it. So I think, you know, I almost see it as my mission now to let more investors know that these strategies exist to not only grow your wealth, but protect the wealth that you're building. Because I find like in a lot of the local real estate investor circles, most of the talk is about literally actual investing strategies to grow your portfolio. And the groups do a fantastic job with that. Not too many people, if any, are talking about this. So I'm hoping to change that. So that's why you and I are talking, and I'm very grateful for the opportunity to have this conversation.
So as an investor myself, you know, we're told that there's really no alternative but to pay the capital gains, right?
Oh my God. Okay.
And that's crazy. Right, exactly. So it's sort of one of those things where you just don't know what you don't know, right? And the other mindset around this whole, you know, passing the wealth on to the next generation is the mindset of dying broke, right? So rather than me passing on millions over to my kid, you know, really what I need to do is give him one property, and the rest I should be living off of, right? And basically die broke from, you know, when I die, and just make sure he has one, because, you know, I wasn't given a silver spoon when I started off, right? So, you know, there's that whole being overprivileged in the next generation, right? And so now there's this whole mindset of dying broke. But what I love about IFA strategy is that it doesn't have to go to your family member. It could go to a charity, right? And that's where, like, for me, it really makes a big deal, right? Is that I can leave this to one of my the charity of my choice.
You know what? That's more of a philosophical discussion, but I actually agree with you, right? That depending on one's family values, they may not want for their kids, you know, to have that quote unquote silver spoon, but at least having insurance in place to deal with the tax does provide choice, because I think that most people find it offensive when they work so hard to grow their wealth and then have about 25% of that being paid out to the government by way of taxes. So if they have a mechanism that can allow them to at least preserve some of that wealth, and even if it's not necessarily going to their kids, but to charity or to other priorities based on their family values, I think that this works exceptionally well. And that we have clients, very, very wealthy clients, that feel exactly the same way, that sure, they're going to pass on a sizable inheritance to the kids, but they want to give away a lot of their money as well. And this is a fantastic way of doing it.
Absolutely. Absolutely.
Yeah. And Huong, I feel like with, I've come across investors and some investors feel the way you mentioned. However, I'm also meeting an increasing number of investors that are educating their kids to be good stewards of wealth and to respect what it takes to build, in this case, real estate wealth, to understand the management of the properties. And so this is a very individual decision, really. What do you want to do with your wealth? And I do find that one of the concepts that's often touted at real estate circles is, this concept of multi-generational wealth. And if truly that's, and when I hear talk of legacy and so on, and I've come across investors that genuinely will say that I want to build a legacy, I want to create an empire, I want to create multi-generational wealth. Well, I think those are the types of investors that this sort of conversation would appeal to. Investors, and I think most investors are pretty intentional about what they're trying to create. These are goal-oriented people, success-minded people, and 25% would be like on the low end and what you can expect to pay, because you may also have the recapture of depreciation tax, which if you're talking about upwards of 30% or more of your portfolio potentially being dissipated through taxes. So if you have a way to protect against that and give yourself more choices, like, would you rather your money go to the CRA, or would you rather go to causes that you actually care about? Maybe more than Mr. Trudeau and what they want to do with your money, Sorry. So
I actually tried to not get that political, because we're in the midst of an election campaign.
Right.
So I'm going to refrain from commenting.
Yeah.
Like there's just so much content here, like between the part 1 and the part 2, but the part 2 is excellent. Thank you, the both of you, because I think showing that, you can, so for you to explain being able to take that 100,000 and buying the policy first, right? And then turning around and having that 100,000 returned back to me to make a real estate purchase. That's basically doing 2 deals in 1, which is absolutely fantastic, right? And so.
Hi, I'm Huong with Cash Property Inc. We help you, regardless of age, financial situation, and education, get as much money as you want. If you like our video, please click on the like buttons below and subscribe to our channel.